Heading into North American session, markets remain firmly focused on the inflationary and growth implications of elevated geopolitical tensions in the Middle East, with the lack of progress toward any formal US Iran agreement continuing to keep risk appetite under pressure. Oil prices remain elevated, with WTI crude up another 33% on the day and trading above $91 as ongoing military exchanges and concerns around the Strait of Hormuz reinforce fears of tighter global energy supply and more persistent inflation pressures. That backdrop is feeding directly into rates and FX markets, where the broader narrative remains centered around higher for longer global interest rates. U.S. Treasury yields are edging higher again, with a 10-year back above 4.5%, while the dollar remains broadly supported as markets continue to scale back expectations for Fed easing. The move has also been reinforced by increasingly hawkish rhetoric from Fed officials, with policymakers continuing to stress upside inflation risks tied to resilient demand and rising energy costs. In Europe, the ECB narrative also shifted more hawkish today. ECB policymaker Lane warned that second-round inflation effects from the energy shock could persist even after the initial move in oil prices fades, while Sternaris confirmed that a June rate hike remains the most likely outcome. In addition, the ECB April meeting account highlighted intensified upside inflation risks, reinforcing the idea that policymakers are increasingly concerned about energy-driven inflation persistence despite still soft regional growth dynamics. Euro area sentiment data improved modestly in May, but continues to point to lingering economic headwinds. Across FX markets, the dollar is holding firm overall, though some mild month-end flow-related selling has limited gains in the London VIX. Euro dollar remains under modest pressure after failing to sustain rebounds earlier in the session, while dollar yen continues to hover just below the critical 160 level, with intervention risks remaining elevated. Commodity-linked currencies are softer as weaker risk sentiment offsets supports from higher energy prices. Equity markets are trading defensively into the U.S. Open. European indices are lower across the board, while U.S. futures are also under pressure, led by tech weakness as higher yields weigh on duration-sensitive sectors. S&P 500 futures are down roughly 0.3%, while NASDAQ futures are lower by around 0.7%. Beneath the surface, markets continue to grapple with the idea that persistent inflation and elevated bond yields may challenge the sustainability of the narrow AI-driven equity rally. In commodities, gold remains under heavy pressure despite the geopolitical backdrop, with stronger real yields and a firmer dollar continuing to dominate traditional haven demand dynamics. The metal is now trading near 2-month lows as markets increasingly view higher oil prices as inflationary rather than growth negative in the near term. Looking ahead to the North American session, the main focus will be on the latest U.S. PCE inflation report and weekly jobless claims data. Markets will be watching closely for any signs that inflation pressures are re-accelerating, particularly given the recent rise in energy prices and resilient labor market conditions. Fed speakers include Williams, Musalem, and Barkin are also due later today and could reinforce the market's higher for longer rates narrative if they continue emphasizing upside inflation risks. That's all for now.